Welcome, CTKS family, to Downtrends and Losses, what you need to know. Everybody loves talking about profits, but no one teaches you how to survive the pain of losses. Downtrends don't just wipe out portfolios, they crush confidence, destroy discipline, and trigger emotional chaos. What exactly is a downtrend? A downtrend is where price comes, unfortunately, down. Prices are falling and price is making a series of lower highs. It's coming down and down and down. Losses aren't just numbers, they're emotional grenades. They trigger fear, guilt, shame, revenge trading, and self-doubt. But how are trading and investing losses incurred? A lot of people will say it's bad timing or just because the markets are declining. But realistically, when you understand the markets, you will find that most losses actually focus on a lack of knowledge and a lack of experience. This is fantastic news because it means that you can sidestep losses. Now, how can you sidestep them or minimize them? If you do not know your structural levels, you don't know where liquidity grabs will occur, and also, if you don't know intercorrelation and interconnection, you cannot stack probabilities. All of these four things are basic required knowledge in order to minimize losses. There are other reasons that people encounter losses, risking too much on low probability setups. Many people experience low probability setups by these statements. I sold where? At the bottom. And I bought where? At the top. The real key is to understand the structural locations inside your charts. There are also things called CTKS gaps. If you misjudge where the CTKS gaps are, you're going to be in a lot of trouble because volatility can cause losses and then rebound into gains. If you've ever experienced a downtrend and then you sold and then it just went parabolically up, you understand CTKS gaps already. I'm going to discuss those more and give you examples. One key is to recognize high-risk structural levels. High-risk structural levels I'll explain a little bit later on. And many people trade and invest too aggressively at incorrect structure. The good news is, with knowledge you can overcome these issues, but one thing to just keep in mind, you learn absolutely nothing from green candles. Green candles are expected. It's those pesky red candles that cause so much grief to so many people. Losses teach you with a very loud voice. It's a professor that you pay attention to because your portfolio is bleeding. Let every red day sharpen your discipline and not your self-doubt. This is incredibly important. I'll discuss how losses aren't personal and how you can deal with them. Financial markets have many hidden rules and it takes a long time to understand them. Rule 346 is a really good one. Losses are improvement lessons. Whoa. Just think about it like this. The market was probably telling you something. It was probably telling you, I can't get above this particular level, so I'm getting tired, I'm going to come down now. But you may have hoped, you may have prayed that it would keep on going up, but it didn't. It went the exact opposite direction. That is an improvement lesson. Next time, you can look at that kind of behavior and say, I've seen that before. I'm not falling for this again. Last time it cost me a fortune to disregard that market signal. And please bear in mind, a loss is never final unless you refuse to learn. And of course, all the market is doing with a loss is saying, hey, guess what? You need to pay attention to what I'm telling you and showing you inside the charts. Losses are never personal. One thing to always understand, where is your CTKS structure inside a price chart and where are the CTKS gaps? They can be positive, which can see price go very, very quickly up combined with structural overshoots. But if you get structural failures, you're going to get negative structural attraction to lower levels. You can assess all of this before price actually prints. Now, what is actually happening when we get up through very heavy structural levels? These are where the market makers are hanging out and dumping the liquidity into the market. They're not dumping on people, they're just simply rotating their funds. That's what market makers do. And I'm going to explain on the way through this, the reason that you cannot take market losses personally is because the market never knows you. It never knows what you're doing. It doesn't know if you're going long, if you're going short, if you're trading options, trading futures, or trading spot, or anything else. It doesn't know your timing. It doesn't know if you're in for 10 minutes or 10 years. And the thing to understand, there's not one person sitting across the table from you trying to take your money. There are just millions and millions, hundreds of millions of traders and investors pulling their money into the market. And they pull the money in observable areas called CTKS levels. In a downtrend, these levels of structure, the sellers seek to convert those into levels of structural resistance. Once support, become resistance. This is the fundamental nature of a downtrend. This is how you can understand what's happening with price. Price simply can't get through the resistance. It may shoot up to a resistance level above and then structurally fails continuously until it finds a bottom and then interacts with those structural levels. One thing to understand, CTKS gaps can be positive on the way up and negative on the way down. You must know where they are, or you can cause yourself a lot of losses by simply not knowing. One of the important things to do when you see a red candle, please do not panic. Panic is the last thing that you need to do. You need to think. It all starts with the concept that downtrends and negative price volatility, that's not punishment. Markets naturally rotate, and I'm going to show you an example in a minute. Downtrends teach timing. If you don't understand timing, you will suffer, unfortunately, tuition fees in the form of losses. Downtrends are literally transfers of power from the unprepared to the patient. If you're experiencing losses from downtrends, that often exposes a lack of planning. In other words, you just hope, you just prayed the thing was going up and you just didn't have a strategy for if it went down. Downtrends are awesome. They break gamblers and they build strategists. You need to be a strategist. Gamblers, no matter who they are or what they do, they always lose in the long run. You don't want to be a gambler, a retail gambler. You want to be a professional gambler when you gamble. Professional gamblers do one thing very, very quickly. They fold. A very useful rule is Rule 212. Markets demand the tuition fee of losses. What this means is that when you start to gain experience inside markets, you will get natural tuition fees in the form of losses. This is to make you pay attention. It's not personal, it's normal. CTKS traders and investors do something very, very specific, something that other people just simply do not do. They prepare in 3 directions before every single buy and sell, and they do it in a very specific order. First, they prepare for price action that goes against their position. I'm just simply assuming that people buy low and they want to sell high. If you were shorting, you would do the opposite. You would say, what happens if this goes against me? So let's just take the long angle. People just, first of all, inside our community, they prepare for the sell-off. Next, they prepare for consolidations. And thirdly, they prepare themselves for price going in the direction that they want it to go in. It's very difficult to get blindsided if you're saying, okay, this thing could go up, but I'm preparing for it to come down or just flatline before I see my hopes and dreams fulfilled. But there's a lot more to it. CTKS traders and investors know structure before every single entry and exit. They assess structural direction and momentum. They stack probabilities across the high value charts, which are composed from the cheat sheet, and they keep their losses small. Rule 345 is a particularly good one. opportunity transfers from the unprepared to the structured. If you have structure, you will get transfers of profit to you. What your key is, always, is to minimize losses and guard your account. It's very important that you always guard your account value. Here we're going to look at the price volatility in Bitcoin going from basically the start of 2025 just going forwards. You can see these particular paths. These paths are called CTKS paths. They're structurally engineered to show us the upper and lower boundaries of where price can go. That's all about that three-dimensional risk management. Prepare for the downside. For example, in January we saw a really good positive push to the upside, which was followed in February by a very nasty decline. But if you were paying attention to the paths, you already knew that this was on the cards. The thing to understand with these CTKS paths, they're not seeking to predict where price actually goes. They're seeking to tell you where the structure is inside the market for the next 30 days. And when you look at CTKS structure, you're not hoping price reacts to that structure. You are expecting it to react. For example, if there is structure and that structure cannot be breached, you will find a downtrend. Price waves are always following a fairly standard position. They go up, they base, they come down, they base, they go up, they base, they come down, they base. Sometimes they fail, and when we get things like this, this is panic. Panic always causes structural overshooting. Therefore, it's very important to understand that losses are for learning and not for punishment. Inside our CTKS Global family, we call lessons that are made and engineered for learning. We call them lessons. And lessons are your absolute best friend. You turn your losses into your earnings through learning. Rule 344 can help you out a lot. Emotional reactions are the enemy and not losses. Therefore, the problem isn't actually the loss, it's the emotional spiral and emotional chaos that accompanies it. You can think about losses as literally emotional grenades. They trigger all sorts of horrible negative emotions until you understand that the lesson can be accomplished. If you sit down and listen to the market will tell you its truth. The key to understand, it is not personal. Somebody is not taking your money. What's actually happened is that you've given your money to the market. And they say it's very good to give, but not so much in this case. So how do we profit? In order to profit, improve your level of knowledge, experience, and fear management. Fear management is a very important thing that you need to focus on. The markets are all about fear. The fastest way into learning and therefore earning is to know where the structure is inside your price chart. Now, what is CTKS structure really? It's a leading indicator of price. CTKS structure shows you where the market makers, the liquidity providers, will buy and sell with conviction. That conviction can be strong or that conviction can be weak. And this is all done before price prints. Now, what does this mean? You can see a lot of strong conviction by market makers and algorithms around this particular area. A positive CTKS gap, and then liquidity and market makers and algorithms come in and start to sell down. That's exactly why this forward momentum is pushing over. And what happened next to price? It actually came down. Something that will really help you out when it comes to CTKS structure. The stronger the structure is, the more thicker it is and the more clustered it is. For example, these structural levels are quite weak. You may not even see them, but these structural levels are stronger. These are stronger as well. When you get a takeoff of price through a positive CTKS gap, you do an SO or structural overshoot, and that explains this kind of price. The thing to understand, the weaker structure is always thinner and more spaced out. You get a lot of volatility inside CTKS gaps, up to the positive side and down to the negative side. And the key to always understand, these CTKS gaps get filled. And the wonderful thing, you know them ahead of time. Price is always moving in a wave. It's always going up and then down and up and down, and it's all about structure. This is where the liquidity makers, the people who have the real funds, they step into the market to support price or to push it down. And as soon as you get a structural failure, especially if you get several, you've already got a target through negative structural attraction to the structural levels below. It is literally a superpower. Therefore, always know that price waves are not random. Price rallies and retracements follow structure and not chaos. You know exactly where the safety nets are, and if you get panic inside the market, all of this panic will create structural overshoots that require more and more structural levels to rebound them. But rebound them it does. We see it time and time and time again. Therefore, estimating where price is actually weakening is incredibly important. Knowing where the uptrend and the downtrends are occurring is vital. And without CTKS structure, the markets seem completely erratic and unmanageable. This is simply not the case. To help you out, I've created a loss survival kit. You always want to keep your losses as small as possible. If you can't sleep, reduce your risk. That is quite important. If you're not looking at structure, please look at structure, because if you've got structural failure over structural failure, by the time you get to capitulate, which means you're just going to sell it all regardless, you're probably doing so at structural support. Also, stacking probabilities is wildly important. If you know the general market direction, momentum, and velocity of price change, that means you are ahead of the rest. You may be witnessing an intraday sell-off that could be just geographically confined. And always follow your plan. Now, if you don't have a plan, that means you need to get one. What gets you into the market? What says it's time to get out? Are you doing your three-dimensional risk management and understanding that all price waves are structurally bound is an absolute game changer? We know that panic causes structural overshooting, and structural overshooting is where you go through numerous structural levels, and you often see things called hell candles, big red candles, or God candles, big green candles. This is still the same thing. It's structural overshooting. Therefore, if you know the structure, you can think like an institution of one, and that's what our global family is all about. And if you're liking the video, please consider subscribing and smashing that like button. We have the best community on YouTube, and we'd love to have you as a part of it. Rule 344 is particularly good. Emotional reactions are the enemy and not losses. You'll find that after a while, if you make a loss, you just say, "What did the market teach me?" If you learn that lesson, you're on the way to exceedingly good profits. Therefore, increasing profits via knowledge of market structure and rules is the key. We're going to look at CTKS structure, and especially we want to beware of weakening trends. Now, how do we do that? We keep an eye on structural passes and structural failures. For example, up here we see a structural failure, which is accompanied by another structural failure. And because we can see that resistance is fairly strong and also support is quite negative in terms of a negative CTKS gap, we may get a structural overshoot down to lower levels of structural support. So with that in mind, we find that we can create a target through NSA or negative structural attraction. Literally, as soon as you get a failure failure, NSA becomes absolute. So right here, if we fail here, we're going to this level. If we fail here, we're going to this level. But because we've got a weakness in terms of market structure, we can overshoot. And this is why knowing where the gaps are is exceedingly important. If you don't know where the gaps are, that is really, really bad. So you could say that you've got a couple of targets here. Target 1 would be no structural overshoot, just this level. But target 2 is much, much more realistic. Keeping your eye on structural failures is exceedingly important, and when you understand that structural failures just push the price down to the next cluster of structure, especially the stronger structures, this is where the algorithms will kick in. Therefore, downtrends are not that big a deal, realistically. If you understand what's happening with price and you look at it and say, if this was $10 and down here is $7, I would prefer to buy $10 for $7 any day of the week. When people are new to financial markets, they take losses very, very personally. This is why you need self-kindness, compassion, and that knowledge will drive profitability. When you understand structure, you can act on it, but you must control your fear. We know that price is always moving in a wave between structural levels, and these CTKS paths, they simply show you where the structure is. Now, when we look at something like this, we can see that from January, you see quite a few months, January, February, March, April, and May. Now, where are the uptrends occurring inside this particular structure? You can see them pointed out in green. So uptrend, 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 uptrend. You can see that there are many uptrends, even when things are going negative. If you're buying correctly and with a structural understanding, you can really do quite well. The CTKS method doesn't care if price is going down, it's going up. We simply look at structure to guide our structural failures or structural passes. And you can trade those levels to great effect. Of course, you can also invest in them. So if we look from the other side, so we have all of these uptrends here, but what about if we look from the other side, all of these downtrends? You can see there are many, many downtrends inside market action. The major problem that people have, they confuse a short-term downtrend to mean the markets are heading towards zero, and a short-term uptrend to confuse the markets heading to infinity and beyond. The greatest problem in many respects is social media. Social media is just to create viral tweets, viral articles. Every downtrend is the end of the world. Every uptrend, it's going to $1 million billion. Both are absolute rubbish. Price is simply ranging between structural overhead resistance and underneath structural support, and it's playing this dance again and again and again. If you know where the structure is, you can short circuit all the incredible amount of noise. It's very important to know where the structure is, and if you don't know where the structure is, you cannot read across charts. You can't stack probabilities because you're only looking at the chart that you put money into. You will become desynchronized. This is a major cause of losses. It's important to understand that fear, blame, and a lack of knowledge are the major primary drivers of losses. And because that's all in your hands, the good news is you can fix it. Unfortunately, a lot of people try to fix it by punishing their way into healing or punishing their way into success. It doesn't work. You must be kind to yourself. You can think about it like this. Inside your own life, you will have life rallies, you'll have life pullbacks, life rallies, life pullbacks, life rallies. When you're getting a life rally, hey, everything is fantastic, but when you get a life pullback, that's a time to contemplate, to think. What is truly important? It's like getting a big hell candle inside financial markets. But always know the sun will always come out again, and if you're going through a life pullback, as Oscar very nicely said in the comments, the sun will come out again, and you're not alone. With a knowledge of structure and a knowledge of just preparing yourself for three-dimensional cases, if it's not going one way, for example, just consider Bitcoin in January 2025. It was just romping up and a lot of people thought, yeah, it's going to take off, but it went the exact opposite way. By doing your three-dimensional risk management, you were already aware of the structure that could create such a problem. Your eyes were open. Yes, all of social media was abuzz of Bitcoin hitting X dollars and the stock market's rallying and your favorite stock doing all sorts of things. But when the market does the opposite, you must be prepared. Therefore, with the knowledge of structure, even in the wildest of markets, you can find calm and clarity. And always remember, around structural levels, you're not hoping for anything. You're not hoping the price reacts. You expect it to react, because it does. I produce these price paths across these 32 charts which are part of the service each and every month. And for the service members, these particular charts in green have been released. To get more and more synchronized in with the market, you can just visit ctksmethod.org and there's a lot of free resources there for you. If you like these kind of lessons, you'll really love Price Action Masterclass, TA's most advanced method. And as CJ said, that's the ultimate knowledge to multiply your probabilities. And structure is the key to unlock your full trading and investing potential. TF Theta also went on to say the most important 3D risk management is before any trade. And assessing the market with structural levels is the way forward because it's a leading indicator of price. A lot of people think that CTKS structure is just random lines drawn on a chart. It's not true. It requires level 1 and level 2 standard certification. It's literally a skill, just like riding a bike. Once you know how to do it, you can never forget it. And there are a lot of free resources at ctksmethod.org. Please check them out. And if you'd like to learn more, this is a fantastic video coming up next. All you need to do is to click the link above.